Good afternoon and welcome to this free Financial Times event, How to Create and Maintain a Resilient Financial Plan, in partnership with Netwealth. I'm Claer Barrett, the FT's consumer editor and personal finance columnist, and I'll be with you and the experts for the next hour, learning more about this vital topic. So whether you're watching live or on catch-up, I'd like to start by saying, well done. You've made some time in a busy day to focus on your finances, which frankly is half the battle. And we're going to pack in as much as we can into the next 60 minutes. From navigating pensions and inheritance tax changes to cash flow planning and retirement, what's all of that about? And finding a financial advisor. We've got it all covered. Now, if you're watching live, I've got an iPad. You can put your questions direct to me and the experts as we go along. Don't wait until the end, but do please be aware that our answers are intended as general guidance and not as individual tax, pensions or financial advice. Now, without further ado, let's meet today's expert panel, starting with Matt Conradi, who is the Deputy CEO of Netwealth. Welcome to the FT. And Karen Barrett, no relation, although we have yet to go back a few further generations. Karen is the founder and chief executive of Unbiased, which helps people find a financial advisor. And then over the line, we have Sir Steve Webb, the former pensions minister and now partner at LCP. Steve, you can hear us loud and clear, I hope, where you are today.
I can, thank you.
Excellent.
Good afternoon, Claire.
A pleasure to have you with us. So, Matt, I'm going to start with you. To say that we've seen some ups and downs on global stock markets in the last few weeks and months, a bit of an understatement. Things, thankfully, now back to around the place where they were before. But is it fair to say that people who do have a financial plan tend to panic less at times of extreme market volatility?
Yes, that's exactly what we see from our clients in general experience. And I think it's because often what's happened is what happens. It goes down and then it comes back up again. And the financial plan means that you can avoid two things. One is being a forced seller. So your plan might involve having an emergency cash fund. That's what you dip into at the wrong moment. And it will also stop you being an uncomfortable seller. So where we think about is how to match up different pots with different goals. If you have that plan, although one part of your pot might be down quite a lot, maybe your pension, a long-term portion, you're more relaxed about it because you know another portion that you might need in 2 years' time is moving a lot less, and it's matching up those different parts. So we find that clients that have that plan, it certainly helps. And the other thing is perhaps sometimes just passing it on to other people. I know even for my own money, it's much more emotive when you look at it yourself. It can be easier to let someone else deal with those ups and downs.
I mean, there's been some days in the FT newsroom upstairs where I've had colleagues coming up saying, oh my goodness, look at the app that our workplace pension is in. The pension's gone down by X%. And I just say, why are you looking at that? You're in your 40s. You're not going to need that money until your age starts with, a 6 or higher. So the temptation to fiddle, I think, if you do look, can be
That's
too
it.
great.
If you know the purpose for each pot and you know when you're likely to access it, then you'll be less likely to fiddle with it, less likely to play with it. Whereas if it's just a series of individual investments, it's much harder to work out what the right thing to do is.
I like that, a purpose for each pot. Now, Karen, turning to you now, what are the trends that you're seeing at Unbiased in terms of the sorts of things, different areas of financial advice that your customers want to find help with?
Yes, it's really interesting. About half of the inquiries that come in, and we deal with hundreds of thousands of people looking for an advisor each year, they're looking at pensions and retirement planning. A further 10% are looking at planning more generally and holistically, want to get a grip on their finances. What we have seen recently, and with the incoming Labour and some changes in financial policy, is we've seen a jump in estate planning. So the trend really is that people are concerned about the changes. So 1 in 4 in the recent few months that have searched for an advisor have done so because they're concerned about changes happening, particularly with pensions, retirement planning, and inheritance tax.
And estate planning really is just a catch-all term for who you want to leave your money to when you die.
Yes, absolutely. Also, interestingly, we have, in terms of planning, the big really groups are baby boomers, so people in their 60s and 70s. 11% of them have got £1 million more in assets, not including their house, and they sit on 52% of the wealth. So they're really concerned at how they can tax efficiently leave that on to the generations below them. And then we have some other trends, which really are women getting more share of assets. So by women, by 2030, 60% of the UK's wealth will be in the hands of women. So I think there's some general reasons why people are coming to look for an advisor. Generally, it's around, I've got a big problem, it's complex, I want some help in getting me to plan. To your comments, Matt, earlier, people feel happy if they have a plan. So if there's even changes around pensions, etc., which they don't know, if they have an advisor already in place, they feel secure that when the legislation does become clearer, they're set up really well to interpret that and adapt their strategies quickly and make the best of the situation. So I think that's what's driving many of the inquiries that we're seeing of recent months.
And any women watching, don't forget, questions. Tick the box on your screen and it will pop up on my iPad. We're very eager to hear from as many of you as possible in today's session. Now, turning to you, Steve, remotely, I mean, obviously, big changes afoot in the pensions world. You know, Karen's mentioned the problem with inheritance tax. Pensions are going to come into scope of inheritance tax. The government is planning in 2027. So they've given us warning. They haven't given us huge amounts of details about how that will work. Would you like to give us your overview as the former minister in charge of this hugely important plank of retirement?
Yeah, sure. I mean, I think one of the big changing areas is workplace pensions. So basically, successive governments have said, well, we can't tax people a lot more, we can't borrow a lot more, but we want to get stuff done. And they've looked at £2 trillion in people's workplace pensions and thought, we'll have a bit of that. Not by taking it out, but by putting pressure on these schemes to invest. So this week we had the Mansion House Accord with all the big pension schemes, so they'll invest more in private markets and infrastructure and those kind of things. We've got a pension schemes bill coming up, which will be a real smorgasbord of changes to things like how we shape our income in retirement, what happens to all those small pension pots scattered all over the place, what's happening to defined benefit, traditional final salary pensions, many of which have got spare cash, and whether companies will be able to take some of that money out. So the sort of waterfall of workplace pension changes. And then, Claire, as you mentioned, at the more individual level, the big change in 2 years' time is inheritance tax applying to pensions. And I guess the key thing I'd say there is that although we don't know exactly how it's going to work, it would be astonishing if it didn't happen. And the reason I say that is there's been almost no political heat. All the heat's been on the tractors driving farmers. There's been almost nothing about the pensions change. So the Chancellor's banked the money and moved on. So there's going to be no big U-turn on this. We'll wait to see if HMRC are changing the way they're going to do it. But I think you should plan on the assumption that it's going to happen.
Okay, well, plan on the assumption that those inheritance tax changes are going to happen. Now, Matt, devising a financial plan with somebody like one of those wealthy boomer clients, perhaps, that Karen mentioned, hello boomers, if you're watching, hello people who might be receiving some cash from a boomer, because these people need financial planning assistance too, often with working out how they're going to spend the money. But let's start with those who are sitting on it now. Now, I think we've got some slides that you're going to show to talk us through two potential scenarios of the impact of giving early, because this really is emerging as the key way of trying to get around those higher inheritance tax rules in the future.
Yes, absolutely. Look, I think we're going to put up some slides that just show about the power of financial planning. And why do you do financial planning? Well, the point here is to think about the future. What could happen? What changes you could make? And we think that really comes down to a bit of a wealth projection. Okay. So what might happen to my money in the future? Don't
be scared, folks, watching at home, by these charts.
And that's it. There's a lot of information here. And really, it says, in many ways, you'll have a series of circumstances for you. So this person's got about £1.5 million across some pensions, some ISAs, some taxable investments. It's a couple as well. And we've got to think about that And then they're going, right, well, there's a whole bunch of uncertain things. I don't know how investment markets will go. I don't know what happens with inflation. But the point of doing this modelling is that you can then make some more informed decisions about your choices.
Okay.
And what we had historically was under the old rules where pensions were outside of your estate for IHT. People were saying, I don't have to make a decision about passing the money.
I'm not going to touch my pension.
Exactly that. So this chart is looking at a scenario where someone was just leaving their pension till last and only drawing from it when they needed it. They could think of it a bit like an insurance policy. It was sitting there growing. If they needed it, they drew from it and paid tax on taking the money out. But if they didn't, it passed on tax-free to their children. Great. What a wonderful situation. Well, that rule is changing. As Steve said, it's pretty likely that it's definitely going to happen now. So April 2027, we need to rethink the strategy. And there might be an opportunity here for a couple of things. What we've found is it's meant a lot of people are going, should I start gifting? Should I start passing money on now? Or should I just readjust my strategy? So the second slide looks at someone who does a combination of those things.
Okay, those blue lines have shifted. It's a bigger wave.
Exactly that. And in one part of it, they've at some point after retiring, they've decided to give away some money to their children, £200,000. The first thing is a big chunk of money. Can they afford to do that? That's really hard to work out. When you're first at that point of retiring, there's so much going on. Perhaps all of your day-to-day has been focused on your career and what you've been doing. There's all this uncertainty. So the modelling forwards helps you think about whether you can afford to do that or not, and what's the right amount and to give. For most people, it's not a one and done as well. You're going to do this in stages over time.
And you may have lots of children.
You may have lots of children. You may feel very relaxed about giving them some money for certain purposes, but you might be worried about what they're going to do with it if they're still young or if they haven't just got married, for example. There are risks associated with that, and it's always going to be a balancing act. The modelling helps you make more of those decisions. It can then also help you make decisions about how you actually think about the planning for drawing down. So in this scenario, what they're doing, instead of leaving the pension till last, they're blending their withdrawals to take out some tax income from their pensions to not pay too much tax, stay in the basic rate band. And what that does is it means the pot at the end is no longer in their pension. The pot at the end is outside of their pension. So it's subject to inheritance tax, yes, as the pension's going to be. But the big difference now is that if it was in a pension, the beneficiaries would pay income tax to get the money out of it.
Right.
If it's outside of the pension, they don't pay that. So what we're focusing on is that there's more money left for the beneficiaries, which is the kind of the objective. And this is one way of doing it. It's just changing where you get your money from through time. It's technical. It needs to be thought about. It's different for different people. But the point is there are some things that you can definitely control. You can't work out exactly where you'll be on that blue whale because of markets and inflation, but you can say, in all other things being certain, we can reduce the tax by being sensible in our planning, and I can have the confidence to make a gift today, and that can have a much bigger impact as well. If you think about the value that 200,000 could have, it could be helping the children get on the property ladder, for example. It might be
childcare costs.
Exactly that. Those kinds of things can have a real meaningful impact. And the reason
starting a business
completely, and these things are only you can work out how valuable they are because they're individual to you. But it's definitely worth understanding the choices you have.
Now, give us the bottom line, because on that example, you have a wealthy boomer couple. The impact of them giving away money early, how much could that have saved them in inheritance tax in that example?
Yeah, in this example, by giving the money away early and changing the strategy, they save about £200,000 in this scenario, and that's with an estate that's worth £800,000 X their property and so on at the end. So it's a meaningful percentage of that estate that they're saving. And it's really not just the inheritance tax part, but it's also the income tax difference around a pension as well. The fact that money is going to be subject to tax when you take it out. So every example will be slightly different, but it's definitely worth having a look at this and not just ignoring the situation.
Okay, well, people watching, hopefully that is a useful illustration of the kind of cash flow planning that you might get if you went to see a financial planner or a financial advisor, and the ways that they can help you look at you and your assets and your family and what you want to do. But I mean, Karen, in your experience, like based on that scenario, are more people looking to give away money now in response to these IHT changes coming down the tracks?
Absolutely. The advisors on the platform are telling us that they're looking at strategies to withdraw more from pensions and, in addition, as Matt says, to gift earlier than they would have planned to. But it's quite interesting where that people don't seem to think they need to plan. They pretty much put it off and think, something will happen when they die and the money will be passed further down. And actually, one of the biggest barriers we find to people seeking advice is the cost of advice. Now, Matt's just given a really compelling figure in terms of what they could have saved, the benefits of passing on gifting earlier with what their children and grandchildren can do with the money. It does make sense in many cases to have this advice, yet people are put off and don't think it's relevant for them, that they haven't got enough assets, or the cost is going to outweigh the benefits. And I think it really just does underline how go and speak to an advisor, get your stuff together, get your statements. I know for anyone who's listening, you could be just thinking about planning, or you could actually be a sophisticated investor. But when it comes to these big financial decisions that have really big impacts for you and your family, I think it really does pay to have those initial conversations with an advisor.
I think when it comes to paying as well, pay for the right things. Find people that end up in investments and so on, where they're paying for, say, active management that isn't working for them. They're not getting that benefit. But advice can be really meaningful. So it's obviously there's some sensible rules about not paying too much in fees, but there are certain areas where it makes complete sense to get that support. It might be the same as a will, for example. It makes sense to go and talk to someone about that if you've got a large estate.
Now, I mean, Steve, just to bring you in here. Now, you've seen both Matt and Karen talk through, this desire, a really big step change in the way that people are looking to give away money in pensions, or indeed spend money in pensions earlier on. Give us your thoughts on how this is changing and what might be motivating families to do this.
I think one of the interesting things that's changed almost in our society is the age at which we inherit has been going up. So, back in the day, if your parents only lived into their late 70s, early 80s, you could expect to inherit in your 40s or early 50s. But as our parents live longer, and usually the main inheritance comes on what you might call the second death. So, a man leaves to his widow and then she leaves the bulk to her children. They, in turn, can be potentially in their early 60s when they inherit. And so that's a new thing we've got to start thinking about. And, of course, for many people, inheriting at 60 is a lot less use than inheriting at 40. So rather than wait until I die and then my kids get something when they're 60, I like this phrase, giving while living. This idea, I mean, it's the Bill Gateses who give their billions away who that phrase was coined for. But the ordinary person with some wealth can think, well, actually, could I do more for my children or grandchildren if they had some of my wealth now, when they can use it to get on the housing ladder, help with a career and all the other things you mentioned, rather than kind of waiting and then, if there's something left at the end, pass it on. Now, obviously there are risks, as Matt mentioned, will I need care in later life, and do I need to save something for that? Although none of us can really predict whether that will be kind of tiny or massive. I mean, it really is something of a lottery. But I certainly think in terms of people who want to do more for their children and grandchildren, thinking about this early giving, not primarily for tax reasons, although potentially for tax reasons, but also just because it will have more impact. And I just finally, Claire, remember one person, I wrote an article about this, someone wrote in, absolutely behind you, Mr. Webb. He said, I gave some money to my daughter, she was able to build an extension, and now I've got somewhere to stay every time I come and see them.
Very good. Yeah, be careful. Be careful what you wish for. But Karen, just on the other end of this, like, people who are receiving money, because that is a significant driver, as you were saying, of people looking for advice. I mean, obviously, buying a property, getting ready to do that is one obvious port of call. But how else might people be looking in the younger generation to manage their finances? Like, for example, are the older generations thinking about gifting them a pension contribution for their own pot to build up in future?
So what we're seeing is that people in their 40s and 50s, so typically the ones who are inheriting at the moment from the boomers, they are going to advisors and planning to some degree, but not using their parents' advisor. They're more likely to engage with robo-advice or digital and be putting the money into more digital online type accounts and investment. Typically, we do see, though, that if there's tax issues or if the amount is large, and 8% of that group that I'm talking about do have more than $1 million in assets, so it can be significant, they will go and seek advice. And actually, it will be the transformative event for them. If they haven't sought advice in their career to date, that's when they will actually do it. I think it's interesting, Matt and I were speaking before about some of the parents aren't including children in their plans, and it's very much my money, my plan, and it's only on the death or on the inheritance that the plan is seen. I'd encourage people to communicate, have those conversations and plan together, because I think it removes a lot of uncertainty in terms of what was meant, what was, you know, intended with this. And just to Steve's point, in terms of, I can see a growth trend in inheritance being left to grandchildren and jumping the next generation down, just because it can be really difficult, and actually putting money to a younger generation is actually more useful, more helpful, and has more tax advantage to it.
Yeah, absolutely. Okay, well, we've got loads of questions flowing in on the iPad, which is fantastic. Now, an awful lot of them, I have to say, about inheritance tax. I mean, inheritance tax, I find it difficult to write about as a journalist, let alone understand it as somebody who is part of the UK tax system and a UK taxpayer. So, Matt, let's start with the 7-year rule. Lots of people are saying, can we just clarify how that works and what that means? That was obviously in your example with the people giving away £200,000. And then when you've done that, if we could stay on IHT and then talk about gifts from surplus income, which is another popular question from people watching. And I'm going to read through some more of your questions while Matt gives us a little lesson in those things. And feel to chip in at the end, Steve, if you have more to add.
Okay. Well, yeah, look, Claire, gifts generally fall into one of those two categories. And let's start with that 7-year rule that's normally talked about. Most of the time when you gift money in the UK, you're doing what's called a potentially exempt transfer. So this is, you can gift any amount of money, a pet, exactly that. You can give away as much money as you like. And if you live 7 years, it falls outside of your estate. Now, in between that, actually, after 3 years, there starts to be a taper of the tax rate that would apply to it as well. So it makes sense to get on and gift as much as possible. There can't be any control of this. There can't be any reservation of benefits. So we sometimes hear people talking about, what if I gift my house but I keep living there?
Yes.
That doesn't work. That fails. But it can be a really sensible way, and a lot of planning is around giving pets that 7-year rule. So it encourages to get on a little bit earlier and think about doing that in advance. So that's back where that sort of cash flow modelling helps you understand what you can afford to give today and do that around the way. A second strategy that you mentioned there is that regular gifts out of excess income. And the regular is a really important part of this. And this is particularly interesting. Now there's going to be these changes to pension rules. So if we think about how that works, if you make regular gifts from excess income, so this has to be income. Now, income it can form a few different ways. It can be pension income, it could be employment income, it can be dividends, even inside ISAs as well. Dividends and interest counts towards it. It can be any withdrawal from a pension, including tax-free cash.
Okay.
But you need to prove that after tax on that income, you have excess income for your quality of life, and then you can give that away. And as long as you have a plan to do it regularly, so either you've been doing it consistently or you plan to do it consistently, then that money moves outside of your estate immediately.
And that could be every month, every year?
Absolutely. You just need to keep documenting that it is excess, and this is where record keeping becomes really important.
Okay.
It can't impact your quality of life, and you can't say, well, I've got 50,000 of income, and I'll spend 50,000 of capital, and that means I've got excess income. If you need 50,000 a year to spend and you've got 50,000 of income, you've got no excess income. So it used to be that really what you could only give away was the extra, the growth in your assets. If you think of it that way, you can only give away the excess. With the change to pension rules, it's potentially becoming quite an interesting thing for people to consider, particularly over the age of 75. So you wouldn't historically have drawn money from your pension at that point because you could pass it on free of IHT. Now, over age 75, if there's going to be IHT on the pension and your beneficiary are going to pay income tax to take that money out of the pension, it suddenly becomes potentially interesting to draw more money from your pension, have excess income because of that, and then gift that away.
Give the excess income
because
away.
then you're not paying IHT on that pension. And so we're definitely seeing older clients that are feeling like their plans have really been sort of thrown up in the air because they had thought that their pension was going to be part, thinking about how to do that. The real challenges that we have here is that the rules are not particularly clear. So it talks about regular, it talks about excess, but what is regular? It's not completely clear if it's 3 years, 4 years, 5 years. I think the point is to do it consistently and to do it with a way that is hard to challenge that it was excess income as well.
And also, with the paperwork point, the solicitor who I've just redone my will. Are you proud of me, Karen?
Well done. I am.
I do it every 10 years. She, because I'm helping my stepdaughter, paying for childcare, giving her money regularly, she said, just fill in this special IHT form as you go along with the gifts that you're making. Do you want to tell people watching about this form? Because it's something you can just print off from yours.
Absolutely. I believe it is IHT 403.
I was going to say 403, but
yeah,
I wasn't confident.
So I had to look that up before.
IHT 403.
This is the form, actually, that on your death, your executors would use to say any gifts that have happened in the past. And this is why it's really important to have records of gifts. But inside that, there's a section on this excess reportable income where you can put down your income, put down your expenditure, show the excess, and then show those gifts. Now, if you really want to help out your executors, fill out this form on a regular basis, and it will make it much easier for them to do that. I think any gifting documented, and whether it's a pet, all these regular gifts, it's going to be much easier to prove, because the slight challenge with what's happened there with that. So the more records you can have, the more evidence you've got, the better it will be for this. And it's got to fit into the wider plan. It's probably, for most people, IHT planning, it will be a combination of things. It'll be some pets, it'll be some regular gifting, and it might be paying some tax. And then perhaps maybe we're seeing more people inquire about life insurance against IHT liabilities as well. So there are different ways to think about it.
Well, certainly, you've knocked off about 3 or 4 different questions from viewers. I mean, just a statement from one. I'm in my mid-70s. Over the years, I've put significant money into my pension. I feel that with the IHT changes, I need to reconsider how to apply my pension planning. Well, I mean, clearly that is exactly what you've talked about, Matt. Now, Steve, I've got a slightly different one here about leaving money to charity. I'll put the question to you. If you need a minute to think about it, I can come back to you. Person has said, I plan to leave part of my defined contribution pension plan to a couple of different UK charities. How much am I legally allowed to leave to the charities to offset IHT? Well, there is an advantage. Of course, you can lower at the moment, lower the overall percentage rate of inheritance tax that's applied if you leave, I believe, more than 10% of your assets to charity. But this is one of the things that this consultation in the run-up to 2027 really needs to nail down, because it's not clear how that will work in future.
That's right, Claire, and it's certainly something that charities are worried about. Obviously, bequests and legacies are an important part of charity income, and many of them are
very
worried.
Important.
That's right, and just simply the fact of the change might mean that if people just have less to pass on, they'll have less to pass on to charities. So Matt may want to come in on the exact practicalities, but I did just want to throw in just a slightly broader question before we revert to the detailed one, which is I think all of us were keen that the message from this webinar wasn't pensions, boo, the government are taxing, there's no point saving in a pension. I think it's, you hear people sometimes say, well, what's the point in saving a pension now I haven't got IHT protection? But still, you've got the tax break on the way in, the tax-free lump sum, the employer contribution, the fact that many people save at higher rate relief, but only pay tax at basic rate in retirement. So there's still a whole bunch of attractions to pensions. So we're still all pro-pensions people, even though the rules are changing.
No, absolutely, and I'm glad that you have made that point. Fortunately, nobody has asked what's the point of pensions, which is good, because as you say, you do get the employer contribution. Younger people who are watching, that's one of the key messages that I try to instill in people. Different employers will pay different rates into your pension. Some employers are much more generous. Some will just give the bare minimum auto-enrolment, which was one of the really successful policies that a certain Mr. Webb, I believe, had a hand in rolling out. So you're automatically put into your workplace pension now if you join a company and earn above a certain level. But there is a bit more to it than that. And certainly, if you're somebody who's looking to pass on wealth to your children, well worth asking your adult children to find out from their workplace pension provider if they pay in a little bit more, will their employer match it? Because then you could potentially fund a regular contribution for them to use to top up their pension with and get a bit more money from their employer, get a little bit more tax relief. These are the kinds of intelligent thoughts that readers should be having.
And I think, just to second what Steve's saying, is that Advice and planning is around operating the best you can within the structures that we have given to us. Never mind that they're changing or about to change. The planning really helps you optimize and have a goal and understand where you are in getting to that goal. So I wouldn't want anyone put off by the thought of it's too difficult, things are changing, I'm just going to sit tight and do nothing. Just to give you an anecdote, my parents did some planning. Unfortunately, my dad died within the 3 years. But what the benefit of that was that my mum had a contact with an advisor. There was a plan that was in place. She knew what was there. And, you know, we were able to move on as a family because plans had been put in place. You know, it is a bit of a lottery about when certain things are going to happen. But I just really want all the listeners and watchers to understand that by having a plan, they're going to be more confident. They know that they're looking after their loved ones. And something that we really get at Unbiased is people are emotionally looking to take care of their loved ones. Yeah. And that's what the planning's about. It's not about how much is this advice and how much am I paying on this investment. It's about, let me make a plan where I'm putting eggs in different baskets to, you know, to come up with the best outcome I possibly can plan for. So it's really just to encourage everyone to gather their information together, to do a bit of life admin and take that first step, really.
If you think about the goals, it makes it a lot easier. If your goal is to minimize tax, that's not actually a goal. Why are you doing that? You're doing that to make sure my children have education or that I can pay for accommodation. If you start to do that, then you can be more relaxed about the trade-offs that inevitably will exist. And you can find out which ones are more important to you versus others. So we've talked about giving away a lot of money here. There's always a control question. How do you feel about handing that money over? And that's a trade-off. It's very tax efficient to do a pet when you're young and pass it away.
Give the money to the kids.
Absolutely.
What if you need it again?
then you feel, you know, people often say, well, what happens if they, you know, they quit their job or they turn up in a Ferrari? That's not the objective, right? So I think that's all about understanding that trade-off and then thinking about other ways to mitigate it. That might be education. It might be bringing them into that plan, having the advisor talk to them about it. There are lots of counter arguments, and it's just finding that balance.
Now, on Karen's point about making your spouse especially feel comfortable about how they would manage financially if one of you died, we've got a couple of questions. I'll bring you in on this as well, Steve, about age 75. Now, somebody said, if I die before the age of 75 or, in fact, after the age of 75, does that make a difference with what my widow would have to pay on the SIP that she inherits? Would they have to pay income tax? I don't know, Steve, if you want to take that one or if Matt wants to.
Yeah, no, happy to do that. Yeah, so I mean, the age 75 is an income tax point. And so 75 was set, I think, probably half a century ago when people didn't live much beyond 75. So the idea was up to 75, you can get tax relief when you save into a pension. And if you receive money, unspent money in a SIP, it's free of income tax to the recipient. And that's still the case. So even with all these IHT changes, the income tax position hasn't changed. If you die under 75, you pass on pension, then the person who receives it does not have to pay income tax. Whereas if you die after 75, they do. The way it works depends on whether it's a lump sum or a regular, whether you can take it in drawdown. But the basic principle is income tax 75 matters, IHT it doesn't.
Interesting. Anything that either of you would like to add to that?
No, I think that's the really interesting turning point, though. It's when people are then thinking about drawing from their pension to give away. So it's after the age of 75. I think if you're 65 today, you shouldn't be worrying about the IHT on your pension in terms of lump sums and big amounts, maybe sort of regular amounts, but that tipping point really is age 75.
And then final question, Steve, on age 75. Somebody has said, do we think that the current approach to the tax treatment of pensions on death before/after 75 will remain in place? The current technical documents seem to suggest that they will post 2027, but this is important for me when I'm thinking about tax planning. I don't know if any of you have a view about whether the 75 will stay. From what you were saying earlier, it sounds like it probably will.
Yes, I mean, there's been no indication that it will change. You can never say never with these things, but you often have to judge, this famous phrase about plucking the goose with the minimum amount of hissing. They want to raise tax, but they want to do it with little fuss. Would they raise much tax? Because most people don't die before 75. They wouldn't raise a lot of tax if they applied income tax to pensions passed on before 75, but they might get an awful lot of grief if they did. So they may judge it's just not worth it. And then that slightly raises, Claire, the wider question about we've got another budget coming in the autumn. The Chancellor's apparently still short of money. So no doubt we'll get another round of speculation. Is tax-free cash going to be capped? Is high rate relief going to go? My view last year was that those things...
Give us your thoughts on this, Steve, because people are asking, especially about tax-free cash on the iPad. That seems to be the biggest fear still among people, and it's a worry. I recognise that, but equally, people pulling 25% of their pension fund out of the market, especially if they're still in their 50s and have got decades potentially for that money to compound away. That's not something that you should be thinking about doing lightly without taking financial advice.
Well, to do it and to do something preemptive, you have to believe that they're going to change the rule, and they're going to change the rule on the day and not give you any time to react to it. If you just think about the industry, the pension industry would have to probably stop all drawdowns at that moment in time, because their systems will all be based on tax-free cash and setups. So I think it's really unlikely that even if they scrap the tax-free cash, which I don't think they'll do, that they would also bring it in like on the day of the budget as they did with the CCT changes. I think it's much more likely you'd have a time to react to it. And then that's when you should engage with an advisor. If you've already engaged with someone, it'll be easier to just think about what that means for you. But I think we have seen people, sadly, over multiple budgets panic and take their tax-free cash, and it's put them in a much worse position than if they hadn't.
And Steve, your thoughts? Anything to add there?
Yes, I mean, if they did change something on tax-free cash, outright abolition, I think is inconceivable. I mean, if you thought farmers were angry, Middle England would fill Trafalgar Square many times over if tax-free cash went. But crucially, the Labour Party will be very concerned about public sector workers. So if you have a decent defined benefit pension scheme and you're a nurse or a teacher or a civil servant, you get a chunky tax-free lump sum. And if you suddenly abolished or capped those, ironically, it would be public sector workers who would be disproportionately affected. And that feels like, I don't think the government wants another row with the nurses and the teachers and the civil service. So I would be very surprised, as with high rate relief. I think if they were going to do these kind of things, you'd have thought they'd do it right at the start of the Parliament to give them time to implement it and for the flack to die down. The longer they leave it, I think the less likely it is it will happen.
Yes, and I should flag up ISAs. Lots of speculation in a very well-sourced FT story indeed, which was published on Monday, saying that the Chancellor could be about to kick off a review into the ISA market. Obviously, it hasn't been announced yet, but according to our story, looking at the balance between cash and equities. At the moment, it's £20,000 split between stocks and shares and cash in any way savers want. Could that change in future? Could there even be some kind of added incentive to invest in UK stocks? I mean, this is something that I'm going to be writing about in the FT weekend this Saturday. But I mean, clearly, any changes to ISAs, incredibly popular tax-efficient savings and investments vehicles, are going to be controversial. Your views?
My concern would just be that there's another reason for people to disengage with the whole process. That we've had so many changes, and that's one of the problems with pensions. We hear people going, "Oh, I just can't deal with pensions. I don't know where the rules are," and so on. And that's a real shame, because they're great vehicles, as Steve mentioned. And the same could be true for ISAs. I do think there's probably too much money locked up in cash ISAs that could be invested. But that goes back to identifying goals. There'll be lots of valid reasons for holding cash in an ISA. But I think it's just how you encourage people to understand, what should I be doing? Why should I do that? I think changing some of the rules around how they're sold as well. We often hear people think about, I've got to do my new ISA this year. An ISA is just a wrapper. It has a portfolio in. You can keep building on a goal inside of it. People don't think about doing their new pension every year, but they do think about doing their new ISA. And it's a strange setup. But if we can fix some of those, that would be the more important ones.
Well, I mean, Karen and Steve as well, if you want to come in. One of the regulatory reforms that's on the horizon that really excites me as a person and as a journalist, and as somebody who needed a bit of help myself to get into investing, because nowadays there's a lot more information that's readily out there, especially on social media. Lots of the investment platforms have got really great educational video content. It's much, much easier to find than 20 years ago when I was getting started out. But the regulator is looking at relaxing what it calls the advice guidance boundary. So this is the difference between a platform giving somebody some helpful nudges in the right direction, which at the moment they can't do, even though they can see that customer's circumstances. Regulation sort of forbids them from having a dialogue. This could really fill the gap, couldn't it, between people who are paying for fully fledged financial advice, the sort of plans that we've shown on the screen today, and those particularly at earlier stages who want to get started but just need a bit of a helping hand.
Absolutely. I think anything that's sort of lower touch, lower cost is going to appeal to the masses. I personally, because we look at the advisor sort of community and that level of advice, are particularly excited about pensions and targeted advice. You know, instead of giving whole of market advice, it's people like me, so that generally people going through a retirement process, the decisions they have to make will be lighter touch and they can get more people through those processes. That's amazing. That's really good. But like Matt, I'm concerned that people feel that the whole stability of the financial structure is being attacked with the changing policies. And I really hope that it doesn't disengage people. It does actually get more people to seek advice, which is great for the advisor's business, etc. But I worry that there's groups of people who are just disengaging, not starting investing, not looking at planning as a result of all the changes. So I really think the government needs to be sensitive to that. I understand they have fiscal ambitions that they need to, and goals that they need to hit, but they have a long-term plan here where they need to keep engagement of the UK consumer. And Pension Freedoms did a great job of that, actually. You know, people could more flexibly plan their futures. I would hate to think that the policies that come out now, which are putting more rules in place around how you invest in your cash and your investment ISA and how you manage your pension, detracts from that, because we've come so far. So yes, for targeted advice, let's be really careful, please, government, on how you're setting the UK consumer up for the planning of the future, because let's remember, the people who invested in pensions today, they thought that they were understanding the tax regime under which their pensions would be treated. And to have that change now, when there's no time potentially to replan to the degree that they might need to, is quite, you know, distressing for them. And we're definitely hearing that from consumers on the site.
Yeah, less complexity, not more.
Absolutely. Simple, understandable rules. I think nudging and education and that targeted people like me do X, Y, and Z, all really good steps forward. Let's not spoil it with some, you know, too much too quickly in terms of the policy changes that are coming into play.
Sure. Now, Steve, I'll bring you in here because I was hearing last week at a conference that you were speaking at, in fact, so a look into the future with some whizzy, semi-guided solutions, I suppose we could say, that some of the really big pension providers are thinking about rolling out in the future to help retirees who have a defined contribution pension, a big pot of money. You save into it throughout your working life, then you come into a large pot of money at retirement that you've got to decide what to do with. And traditionally, in the last 10 years since pension freedoms, people have thought, well, I can keep the money invested in the markets and draw down an income from it. So I've still got investment risk. That's called drawdown, understandably. Or the other alternative is to use that money and trade it in for an annuity where you're buying a fixed income that will last for as long as you do, with the downside that when you do die, there isn't any money left, or very little money left, often to pass on to your heirs. But you were hearing from pension providers last week that actually finding new ways to kind of blend these approaches and also help consumers through this process is what we could look forward to in the future.
Yes, I think the big change is going to be that it isn't an all or nothing decision. So if more of us arrive at retirement with hopefully a bigger and bigger pension pot, we don't simply have to buy an annuity with all of it, put all of it in drawdown and try and manage that for 20 or 30 years. What the providers are doing is kind of what they call default. So things that will happen if you don't make active choices. And one of the pension companies has got 3 pots. So a small pot of essentially cash. So if the boiler breaks or you need to replace the car or something, you've just got some cash on hand. a pot of money set aside for a later life annuity. So in this example where you turn 80, that money that you've set aside and has been growing a little bit over your retirement is then used to secure you an income for as long as you live. Because if you make it to 80, you might live 3 years, you might live 13. It's incredibly difficult to manage a pot. So that takes that uncertainty about how long you'll live for. And then the bulk of the pot goes into the drawdown you described there, Claire. And the point about that is it's still growing. It's still being invested. Yes, it could go down, but it's trying to get some further growth. And in a world where most of us aren't saving enough, sweating that money, trying to make sure a good chunk of it is still growing, rather than the old-fashioned way of saying, oh, as you get near retirement, you take all the investment risk off the table and go very low risk. That just doesn't work in a world where we're going to live on average 20-odd years of retirement. So depending on who you've saved with, what they offer you will be different, but all of the pension providers, actually by law, in a few years' time, will have to have something of that sort. So it's worth finding out what they're planning for you. And this is targeted particularly at people who aren't paying for financial advice, but still want to do something better than just kind of bumble along or just buy an annuity.
Excellent. Well, thank you very much, Steve, for asking that. Now, sticking with investment, drawdown and investment risk, a couple of questions have come in, Matt, about asset allocation and the amount of risk that investors should consider taking at different stages in their lives. So I'm going to read out a statement from one person. For most of my life, I've held jobs that allowed me to look after my children while I worked. This has had an impact on my pension. Obviously, working part-time is going to do that. So I feel I need to consider maybe a medium and slightly higher risk approach to investing the pension pot that I have built up. Where should I go to educate myself more about this before seeking an advisor? And then second, a more broad question, panel, any thoughts on asset allocation at various life stages and what sort of things might make up each asset category? Now, I appreciate that's quite a broad set of questions, but give us some food for thought.
Definitely. So I think the first thing to say was what Steve actually pointed out, which is that people get to 65 or 67 and think about retirement, and historically they've always been focused on, well, let's de-risk, because maybe they were going to buy an annuity. And if you're getting close to the point of buying an annuity, you don't want much fluctuation because you want to get a bigger guaranteed income. But if you're going to invest for drawdown, then absolutely, you've got 20, 30 years. That's still a really long time horizon for investment. So it's certainly not go all the way from equity investments to cash. That would be a bad choice.
High risk to low risk.
High risk to low risk, exactly that.
Although, of course, there are risks of holding cash for the long term, I feel I should point out.
Absolutely, which is the real one here, which is longevity, which is inflation risk. So those are the things you'd be trying to mitigate. In terms of trying to think that out, you've got to think through three things, really, which is your willingness to take risk, because risk, you'll be less willing to take risk as you get older, probably, because you can't do that. Think of the purpose, think of the pot and go, well, it's for a long, long time away. It's going to matter when it fluctuates now. So your willingness might come down. Your ability might come down, or it might not. That depends on whether you've got cash outside of your pension, whether you've got guaranteed pension income or state pension income. So you might still have the ability to withstand some more ups and downs. And then it comes to need. And I think the crux of that question is someone saying, I think I might need to take a bit more risk. But need is a sort of thing that comes around full circle, because if you do the planning, you can say, well, what are the choices? If I spend a little bit less now, or I plan that actually I'm going to sell my property in 15 years' time and take some money out of it, then maybe you don't need to take as much risk. Those are the way you can have some of those choices. Once you've done that, what we often see is clients actually splitting their pensions or their retirement savings into multiple pots again. You can still say there's a portion of my pension that's 20 years away from being drawn, and there's a portion I'm going to draw next week, and you would invest those differently. So in terms of types of asset classes, conventionally, equities are riskier. You can mitigate some of that risk by being diversified in terms of a number of stocks, but also a number of regions. We've seen this year, quite interestingly, for the first time in a while, US equities have underperformed other markets around the world. But European equities, given everything in sterling terms, are up 10+% for the year. So there are places that you can get returns in even riskier markets. Lower risk assets tends to be government bonds, but then there are nuances to that. If you've put all your money in a 15-year bond, and we went through a period of rising interest rates, which a lot of people with that had pension funds that were on a glide path type strategy towards retirement points, that went very badly for them because there was a big repricing, as you say. So that was fine if you're going to buy an annuity because annuity rates went up. But if you weren't, it wasn't necessarily the right thing to do. I think this is where you can get help from other people in terms of that. There are a whole host of multi-asset funds that you can buy into, managers that will help with these kinds of choices and decisions. And if you hand some of that over and don't pay too much to do it, that frees you up to do some other things that are probably more enjoyable than spending your time trying to work out all of these problems as well.
And Karen, how does this desire to get the asset allocation mix right translate into the kind of things that you're seeing at Unbiased?
So this is exactly why we're putting people in front of advisors, because that's quite specific, and the examples that Matt's just gone through will change on your risk appetite, your age, your goals, and this is why no one answer fits all. It's why we see 50% of the people who are coming to get an advisor are interested in pensions and retirements. We also see themes, as you mentioned, that they're concerned around, which are around inflation, the interest rate environment, the risk and reward of cash versus investments, the pensions changes and what they should be doing in terms of their pensions and the glide path, etc. And the final one would be IHT and housing costs. So I think there's just such a lot for people to consider. You know, you asked a specific question there, but there's a whole range of things that go into people, their finances and the plan.
It's the whole
it comes back to the plan again, and that's why an advisor is so important in talking through options and what if and how do you feel about that, and then, you know, getting all that information and using their expertise to say, okay, this is where I think you're best placed to make these decisions.
And as I have found with my own use of financial advisors, thinking of things that you hadn't thought of.
Yeah, absolutely.
And I say that as somebody who's been a personal finance journalist for nearly 15 years. You know, I
mean, I was the same when I did my will. You know, the thoroughness that the solicitor went through. And what if this happens to your children? What if this? What if that happens to your marriage and their next relationship, etc.? And I was like, well, I hadn't thought of any of those. And that's where the value of the advice really, really sits.
Now, a very good question. I don't know the name of the person who put this to it, but big tick. Karen, can you give us a ballpark figure in cash terms for working with the financial advisor, please?
Oh, wonderful.
I am cautious about all of this depending on my circumstances. Can I get advice for a fixed fee or must I pay a percentage of my assets? Now, this is one of the traditional ways that financial advisors have operated. Said, oh, give us all of your pensions and things to manage. And, you know, it doesn't sound like much, 1% a year. We'll keep on charging you that year after year. But that's certainly not the only way.
No, it's not. Now, that is very, very typical, particularly when you're talking about about investments or pensions. An advisor might suggest a fee of, say, 1.2 to 1.5 for the investable assets as the upfront fee, and then there would be an ongoing charge, maybe something like 0.54. We have a cost of advice calculator on the unbiased.co.uk website.
The cost of advice calculator.
Yes, and what it does is you slide a little asset thing and say what type of advice you're looking for. Now, just to give you some examples, if you were setting up a pension, the advice range might be 1,000 to 1,500. If you were looking for as a one-off fee, and then you would be looking at ongoing costs, etc. If you were looking for a financial plan, that can be quite in depth, and as we've described, looks at a lot of things. That can start maybe 2.5, 3, but is more typically going to be £5,000. I hope you're agreeing with these numbers. There's a whole range, right? And it depends on the advisor, and it depends on what exactly you need and how complex your needs are. I think the whole purpose of sharing these numbers is to start a conversation, and it's to really show people that it's not wildly expensive. You can negotiate and have a conversation about how it's paid. Is it a fixed, you know, for a piece of work? Will it be ongoing? Do you require ongoing? And that's what we're trying to do with that information and with that tool, is to start a conversation so that the advisors are really great at saying, we help people like you. This is the most cost-efficient way of you getting the gains that you need, getting the advice, and this is the cost for it. And of course, as a consumer, you're well within your right to have a conversation and to leave and go and have another conversation and make sure that you're happy with the information that you're being told and the service you get for your fee. Sorry, Matt.
No, I was going to say, you're absolutely right. Those numbers sound about average. I mean, we've spent a lot of time trying to develop solutions that are lower cost than that. So we think some of those are too high in our focus. We think upfront percentage charges can be a little bit tricky for people to focus on. Sometimes, and the regulators getting their head around this as well, sometimes you want just a one-off piece of advice. You want a review. You don't necessarily want to pay an ongoing fee. You don't want to pay an implementation fee, but
There's
they are
all
generally
kinds
worth
of different fees with all kinds of different names.
They really are.
The other thing I'd say is some people are very happy to get the plan and the check-in and execute themselves. I know there's lots of sophisticated FT readers who love managing their money. They understand a lot about different platforms and wrappers and how they can pick their stock. So absolutely, get a plan, have a check-in from time to time and pay that one-off fee.
Something you're missing.
And do the things that you want to do yourself.
That's it. Pay the right fee for the right thing.
Now, there was another amusing question about financial advisors. How does one assess whether an advisor who may have less life experience than the advice seeker is a good source of advice, especially if the future does not look like the past? So, I mean, I would say
a really interesting one.
In some ways, you want to have an advisor who is younger than you, because one of the big problems in the financial advice industries, I'm sure Steve will attest to, is that lots of advisors are retiring.
Well, you know the advisors. I'll let Matt talk in a minute, but just they're qualified. Everyone who's advising, they've gone through their exams. They're regulated by the regulator. They operate as firms, so you're not just getting the expertise of one person. You are actually getting an amalgamated set of experience. There can be some older partners, directors in the firm. There can be some up-and-coming sort of financial advisors, but there's definitely checks and balances, I would say, in the advice being given. Paraplanners often do, work in suggesting proposals, which is then signed off by the different advisors in that business. It's a business. I don't think you're putting your faith in just one person when you go to an advisor.
I think that's a really, really good point. I think there's a lot of one-man band advisors that try and do a bit of everything. It's harder to work with them. So if you want someone to go out and find new business, to offer you advice and pick investments, that's going to be really tough. I think that point about, looking at advisors a bit younger, you want someone that can stay with you and your children potentially over time and support them. If you're talking to someone who's in their 60s, they're probably thinking about their retirement plans, which might involve selling their business. It might involve moving on as well. So I would say, of course, you want some experience. You want someone that's clearly knowledgeable, but go and ask them questions, test them to some degree.
Well, a great question. Steve, I've got a question for you, and then I'm going to put the last question to Karen, which is about what you said earlier about women. But Steve, first of all, at the top of the webinar, you mentioned about the Mansion House Accord and the Chancellor's persuasiveness in getting big UK pension funds to commit to investing more money into UK assets, infrastructure, private investments. Lots of people asking what is essentially the same question. Is this a good idea? Should we be worried, or should we, in fact, be excited about the potential returns on offer? Would you like to give us your reading of the situation?
I'd certainly be worried if the government was literally going to tell pension companies how to invest, and there's been speculation that they'll be forced to do things, and that's not what's happening. So this is something voluntarily entered into by the different pension schemes, and it's looking forward to 2030, so it's not immediate, it's not rock solid guarantee, it's an aim. And I think the reason why we might be reasonably relaxed about this is as these schemes get bigger and bigger, they're going to want to diversify. Just as we talked about earlier, as an individual, you want to diversify. So these huge multi-billion pound schemes do as well. They're not going to stick it all on the London stock market or in government bonds in the UK. They're going to diversify globally and across different sorts of assets. And these, what are called private market assets, so things that aren't listed on stock markets, perhaps tech startup, biotech startups, infrastructure, upgrading the national grid. There is going to be a lot of money needed for these kind of projects, and they will have a return. And in principle, as long as these pension companies are doing due diligence and assessing these things properly, it can be part of the story. It's that the promise is 10%, it's not 90%, so it's going to be part of the mix. Some of it's UK, some of it's global. So, and I think one of the positives for the UK economy is that if all these companies are then looking for projects to invest in, more people might then come forward with projects to invest in, and that kind of helps the economy. And you can see a win-win here. So I think people are understandably sceptical of governments of any colour trying to, use their pension money for other purposes. That shouldn't happen. But I think if it's voluntarily entered into and is kind of in the step of where these schemes are going anyway, it can be all right. And if things go well, actually you can generate better returns than steering clear of these things.
Great. Well, good to hear your views on that. Much more comment on that story in the FT, online, and indeed in the weekend paper this Saturday. Now, Karen, I promised you this question about women. Somebody, I assume a woman, might not be, has asked the question, 60% of the UK's wealth to be held by women by the year 2030. What are the key drivers that result that are causing this trend? Is it due to the life expectancy of women being longer than men?
That's part of it.
Is
absolutely.
It women earning more money?
It is.
It divorce?
It's all of these things. So it's life expectancy. So we have women living longer. They get assets when their partner dies. Earning power. So for many a year now, women have been able to access more jobs just overall. So that shows massive growth. Start companies.
Founder of Netwealth, also female
that can make you poorer as well as richer. It depends on how it goes. But definitely the earning power and, you know, women entrepreneurs. It's one of the fastest growth sectors in the UK. Women here seem to be really great at it. Divorce. So getting assets awarded as part of a divorce, all that culmination. And I think if we go back to when women were able to access credit, that was only in the 1970s. So actually the growth curve is because the generation, probably that I'm in, that you're in, I think we're similar, has been working. We've expected to work. We've had access to credit. We can purchase houses ourselves. We've made money or anyone or any other metals. So just in terms of that growth, it was suppressed for a long, long time. And then in the decade since the 70s, 80s, 90s, it's been growing. And I think it's really accelerated in the last decade because of all those factors that I'm talking about. But also women are becoming more engaged with their finances. They really are. They're using tools, they're budgeting, they're using their banking apps to, you know, say where the money's going, and they have more control over it. And once they have sight over where their money's going, they've always been great at saving and managing money, they're then able to get into investing. And once they start testing that and trialing that, they're as able as anyone to manage investment portfolios.
Very briefly, Matt, your experience at Netwealth, female clients are bossing it?
Yeah, absolutely. We actually have 50% female-male clients in Netwealth, which is quite unusual in the wealth sector.
Brilliant.
I think that's partly because the technology allows people to engage with it, and they find the transparency involved. And we tend to find that actually when someone brings their partner in, when the woman is involved, they get the plan more. I think they focus on the goals more as well. They get less lost in the minutiae and the things that really matter. So it can really be a great thing to make sure you actually are bringing everyone into that.
Okay, well, at which point, I'm afraid we're out of time, but thank you so much for joining us today, and to everybody who sent in a question to put to the experts. Sorry if we didn't get to your particular one. Good luck making your financial plans, and I hope you found this hour helpful. Now, don't forget, you can keep on top of all of the latest personal finance news and views by reading the FT Money section every week in the FT Weekend newspaper. You can also, if you want, take my 6-week money course by email for the Financial Times, which, in a tribute to Stacey Solomon, is called Sort Your Financial Life Out. It's free for FT subscribers, £19 for everyone else, but that includes 6 weeks free online access to all articles on ft.com, including lots I've written about all of the topics that we've talked about today. And of course, you can follow me on Instagram and TikTok. I'm at Claer B. See you next time. Thank you to Matt, to Karen, and to Steve. You have been fantastic. Good luck making your financial plans.